very excited to enhance our loan programs with the addition of HFA Advantage. It's another tool to help lenders approve more qualified buyers. This webinar is being recorded and will be posted on our website as soon as possible. There will be a Q&A period at the end of the presentations. You can submit questions at any time using the chat box, or you can raise your hand located on the control panel. Next slide, please. So I'd like to introduce some team members at this time. On the NIFA team, we have Stacy Fotinos, who is our operations manager. And then behind the scenes, we have Robin Ambrose, who is Deputy Director of Programs, and Amanda Wusk, who is Marketing and Relationship Manager. They are all going to help facilitate the Q&A session. And on the Freddie Mac team, we have David Mendez, the Affordable Lending Manager, Eric Knorr, the Director of HFA Engagement, Kenya Barton, Lender Strategy and Integration Manager, and James Clement, Lender Strategy and Integration Project Manager. And then on the US Bank team, we have Sally Mazzola, who is the Client Sales Executive in the HFA division. Next slide, please. So this is our agenda for the webinar. I'm going to go over some NIFA program requirements. Then we're going to turn it over to David, who's going to talk about some Freddie Mac insights and the HFA Advantage product features. And then Sally is going to go over the US Bank loan delivery requirements. Next slide. Conventional loans have been an important part of NIFA's home ownership program going back to 1996. This slide breaks down our closed loan production over the past 5.5 years by government or conventional. Over this time period, conventional loans represent approximately 55% of the total production. As you can see so far this year, we are experiencing a shift from conventional to FHA financing due to more restrictive AMI requirements imposed by Fannie and Freddie back in September of 2019 and market challenges caused by COVID-19. Next slide, please. The process for entering an HFA Advantage loan reservation in Lender Online is similar to what you are used to now with HFA Preferred. You would select First Home Program or any other conventional program, and then in the data entry screen, you will click on the loan type drop-down arrow and you will select HFA Advantage. Next slide, please. In addition to NIFA program income limits, conventional loans have an 80% AMI qualifying income limit that is used to determine the mortgage insurance coverage and premiums. Program eligibility income includes all persons 18 years or older who will reside in the property. Loan qualifying or 1003 income includes all persons executing the note. This does include non-occupying cosigner income, and lenders should try to keep the total qualifying income below the 80% AMI limit so the borrower benefits from the lower mortgage insurance premiums. Next slide. Lenders should follow the Loan Product Advisor, or LPA, findings to make sure the correct mortgage insurance coverage amount is used to close the loan. This is very important and is hard to cure after closing. A few tips to remember: our NIFA program limits are higher than Freddie AMI qualifying limits. Our interest rate is priced the same for all conventional loans below and above 80% AMI with no loan level price adjustments. And it's best to include the final LPA findings in NIFA's pre-closing file so our team can provide MI coverage alerts when the loan is approved for closing. Next slide, please. Here's a list of NIFA's approved PMI company partners. We greatly appreciate all they do to support participating lenders and homebuyers in Nebraska. Account executive contact information is available on our website and Lender Online. Next slide, please. NIFA requires all occupying borrowers to complete an approved homebuyer education class prior to closing. The sooner the better, we say. Face-to-face classes are approved through a network of nonprofit organizations called REACH affiliates. There are 3 online classes that are allowed: Freddie Mac's Credit Smart Homebuyer U, Fannie Mae's Framework, and eHome America. NIFA does require the completion certificate to be included with our pre-closing package. So now I would like to turn it over to David Mendez and his team. Welcome to NIFA's program, David.
Hi, good morning, and thank you for the introduction. For those of you who do not know me, my name is David Mendez, and I am an affordable lending manager with Freddie Mac. In my role, I work and provide support and outreach to both lenders and agents who participate in HFA programs. We want you to know that we are highly accessible. At the end of this presentation, you will receive my phone number as well as my email address. And then I'm also going to share with you what we call our super secret bat phone hotline, where you can call directly to one of our underwriters and speak with them. We do see that quite often you may have questions about your LPA feedback certificate, and you want to know, why your loan didn't get approved or whatever the case may be. You can reach out to our underwriters and speak with them, and they'll go over that feedback certificate with you. So we'll be sharing that information at the end of this presentation. With me on the call, I also have Eric Knorr, the HFA director. He's sort of in charge of, making this happen, getting Nebraska and Freddie Mac to work together to be able to provide this conventional loan solution for you. And then I also have Jim Clement and Kenya Barton. They're part of the lender strategy team, and they're really involved with the systems integration and LPA, and they are also a great resource for us. Here's my introduction again. Making home possible for 50 years. So just a brief introduction of who Freddie Mac is. Freddie Mac was chartered by Congress in 1970. Tomorrow, Thursday, will be our 50th anniversary. We do have a mission to promote liquidity, stability, and affordability in housing nationwide and in all economic conditions. And I do want to stress, in all economic conditions. We saw, just recently, as early as, March and February, there was all kinds of, private capital out there available for, sort of exotic loan type, bank statement type loans. And as soon as this COVID hit, all that private capital basically disappeared almost overnight. But Freddie Mac is around in all economic conditions to provide that stability and that liquidity, to keep the loans flowing, to keep you in business, doing both refinances and purchase business. We also have a community mission, which is to stabilize communities, prevent foreclosures, expand credit responsibly, educate future home buyers and counsel homeowners, and support affordable rental housing. And then we also have 3 main business lines. The business line that I work in is the single family line, but we also have a multifamily and a capital markets line of business as well. If you're not sure what Freddie Mac does, so again, when I say we provide liquidity, this is sort of a high-level overview of how that liquidity works. Borrower will get a loan from the lender The lender will then sell that loan to Freddie Mac. Freddie Mac will bundle similar loans and then create shares and sell those securities to investors who will give Freddie Mac the money. Freddie Mac will compensate the lender for the loans they originated, and that lender now has more funds to be able to provide more loans to more borrowers. So that's sort of a high level of what the liquidity looks like. And we're talking about a continuous cycle of trillions of dollars in order to make home possible. Just a high-level overview of the state of the housing market. We see that mortgage rates have been declining since even last year. July 19th, Freddie Mac's primary mortgage survey for the first time recorded the average interest rate below 3% at 2.98%. So that was the first time in history of our primary mortgage market survey that we actually went below 3%. So what that means for you is you are probably very busy doing both purchases and refinances, and that's certainly a good thing. We do see that house prices appreciation is slowing down. Housing prices are still appreciating though, so don't misinterpret that. Sometimes when people hear that kind of information on the news, they misinterpret it. So what that means again is housing prices are still appreciating. They're simply not appreciating as fast as they were, say, back in 2017 or 2012, 2013. So what we see here is housing prices continue to appreciate just at a slower pace than they were just a few years ago. In fact, here is the national average. So in the United States, the national average for home price appreciation is 3.6%. And then you'll see, on this map, Nebraska is just slightly higher than the national average at 4%. And then we have some hot areas over in Idaho and Utah at 12% and 7%, where a lot of folks on the coast are sort of migrating east to more affordable areas. Moving on to this next slide, household demographics. So there's a lot of change that's happening and that's going to continue to happen. There's a lot more household formations, and these households are going to want to buy homes. In 2013, there were 653,000 new households formed. In 2019, that number almost doubled to 1.2 million new households formed. And again, like I said, these are potential customers. Millennials living with parents. So there are a quarter of all millennials are living with their parents. But what that also says is 75% of millennials now are no longer living with their parents. In fact, you might be surprised to hear that the oldest millennial is now 39 years old. So, those millennials are looking to purchase homes, and they are going to be your current and future customers for the foreseeable future. Millennial households, they will make up the strongest share of household growth. In 2015, there were 16 million millennial households formed. By 2035, we project almost 50 million new millennial households. So when you're thinking about who are your future customers, it's going to be these millennial households. Now, of those households that are growing, the majority of them are coming from minorities. So minority share of household growth is 75%, and we project that between 2015 and 2025. So again, what that means for you is that your borrowers, you're going to have a lot more millennial borrowers, you're going to have a lot more minority customers, and you're going to have a lot more millennial minority customers. So that's something important to think about when you are thinking about who your future clients are going to be and how you're going to be able to provide solutions such as Nebraska's program to be able to help them become home purchasers. And then we can't forget about households aged 65 and older. Between 2015 and 2025, there will be 31 million households aged 65 and older. And it's important to pay attention to this demographic for a few reasons. Many of them are looking to downsize, so that's a great opportunity for you to not only sell their home, but also help them purchase a new smaller home. But also those households age 65 and older control the majority of the equity in homes in the entire country. And so these are the folks that are also lending and giving money to their children and to their grandchildren so that they can buy homes as well. So you want to make sure that you're paying attention to that demographic as well. This is a great slide. This is an overview of first-time home buyers. So of all the home buyers in the United States, 33% of them, roughly 1/3, were first-time home buyers. And that's a decrease from 34% in 2017 and 35% in 2016. So what we're seeing here is a downward trend of first-time home buyers. It's becoming harder and harder for first-time home buyers, for first-time home buyers to purchase homes. And the national average over the last 50 years was actually 40%. So we're down significantly. And so again, it's up to us to be able to provide solutions to these first-time home buyers to help bridge that gap. The median age of the first-time home buyer is now 33, so that's right in the millennial threshold there. The median income of a first-time home buyer is $75,000. Down payment sources, 78% received their down payment from savings. And so it's important to note that, because that means that a lot of those individuals were spending a lot of time saving for that down payment. And so what that says to me is many of those may not have known about down payment assistance programs like NIFAs. So again, it's up to us to spread the word and let that 78% know that there are down payment assistance programs that can help bridge that gap to home ownership and make it happen a lot faster. 24% got their down payment from gifts from friends or relatives. So again, if you think about, I was mentioning earlier about the age 65 and older, 24% of all first-time home buyers got their down payment from gifts from friends or relatives. 26% used FHA loans, 12% used VA loans. Again, we're talking national averages here. So in the national average, the typical first-time home buyer home was 1,600 square feet and cost $203,700. That may be different in your particular area, but again, we're looking at national averages. And then first-time home buyers plan to stay in their home for 10 years. That's they're staying in their homes a lot longer. The national average used to be 7 years, but people are staying in their homes a lot longer. And so, again, that's causing issues with availability of homes because they are not moving out, moving up. So that just makes the inventory a lot more scarce. Looking at this pie chart here, we see that married couples, 54% of all first-time home buyers were married couples. 18%, the second largest demographic, 18% were single females. 16% were unmarried couples. Single males at 10%, and then other at 2%. So what this pie chart says to me is that certainly females are a lot smarter than males. And I joke, but if you think about who your customers are and who you've worked with in the past, you've probably worked at least on the purchase side with a lot more single females than you have on the single male side. This is a very telling slide for me, and it's the time to save for down payment by mortgage ready population. And so in this slide, what we see here is on average, again, we're talking national averages here, it can take anywhere from 3.7 years to 2.2 years just to save for the 3% down payment requirement on a conventional loan. And if you're trying to save the 20% down, it can take as much as 24.5 years to save for that 20% down. And I know you've probably had a lot of customers who have been, on the fence, not willing to take action because they, in their heads, have decided that they want to save 20% down because someone told them that that was the best thing to do. So, or because they don't know any better. So it's really up to us again to prove them wrong. There's a lot of myths out there, And we need to dispel those myths that you need to save 20% down. And in fact, even at 3% down, it may take a while for them to be able to save for that down payment. And fortunately, there are programs like NIFA's program that help bridge that gap, that down payment gap to homeownership. I want to touch briefly on our response to COVID, because we do get a lot of questions on COVID. To protect those affected, either directly or indirectly, by the novel coronavirus known as COVID-19, the mortgage and housing industry has taken numerous actions. For Freddie Mac single family, these actions include a nationwide suspension of foreclosure and evictions of borrowers living in homes owned by Freddie Mac. So we've stopped foreclosures, we've stopped evictions temporarily. Additional disaster-related loan modifications are available for servicers. So we've always had, workout programs available for other reasons, hurricanes and fires, other natural disasters. But we've now created additional disaster-related loan modifications programs that are available for servicers, and then mortgage relief options for impacted borrowers. And who do these options apply to? So borrowers who are either affected directly or indirectly by COVID-19, borrowers who are unable to make their mortgage payments due to hardship related to COVID-19, and then affected borrowers regardless of whether their property is owner occupied, a second home, or an investment property. And that's a huge shift, because in the past we've seen that usually most of these workout options only apply to their primary owner occupied single family residence. Now we offer these workout options to second homes and investment properties as well. And then Freddie Mac mortgage relief options for borrowers impacted by COVID-19 provide borrowers with payment relief for up to 12 months, suspend borrowers' late charges and penalties, and then allow servicers to offer borrowers additional loss mitigation options. Borrowers experience financial challenges are encouraged to contact their mortgage servicer. So that really is the key. And the biggest question we get is, who do they contact? They want to contact their mortgage servicer, and then explore one of the Freddie Mac workout options with their mortgage servicer. So again, we have multiple workout options. We have loan modifications, we have payment relief, and then we have keeping the payment the same post the forbearance period. So that would involve rolling the forbearance portion towards the end of the loan. But there are multiple options out there. And again, the key takeaway here is that the borrower needs to contact their mortgage servicer. So now moving on to our HFA Advantage program. HFA Advantage is not a standalone product. It's a product that would be used in conjunction with NIFA's program. And these are some of the benefits and features. So it allows up to 97% loan to value and up to 105% total loan to value. Charter level mortgage insurance coverage. So Jackie shared that a moment ago, but I just want to reiterate that the mortgage insurance coverage is roughly half of the coverage required by standard mortgage insurance requirements. And so what that equates to for you is, and for your borrower, is a lower monthly payment. And so what that lower monthly payment indicates is additional leverage for you. So that borrower can now either afford more home, or your real estate agent can submit a much stronger offer. So we know that, especially in the first-time home buyer demographic, that it's very highly competitive. So being able to offer a stronger conventional offer is going to give you more of a chance to get your offer approved. There is no minimum borrower contribution or reserve requirements. However, that's always subject to HFA guidelines. What I would say on the reserve side is, although we don't require reserves, that is a compensating factor. So quite often when loan officers do call our underwriters, they might suggest bumping up that reserve requirement, bumping up those reserves, and quite often we'll see that loan then get accepted simply because they've increased their reserve. So while it's not required, it is a compensating factor and something to think about. There's also no credit fees in price. for area median incomes less than 80%. So most of you know those as loan level price adjustments. There are no loan level price adjustments for the HFA Advantage program. Borrowers can also own one other property. So this is not necessarily just for first-time home buyers. HFA Advantage also works for borrowers who own other properties. However, again, it's subject to the stricter of guidelines. So we would always refer to NIFA's guidelines as well. So this is a great program. It's ideal for borrowers with limited funds for down payment and closing costs. And it's also a competitive alternative to FHA financing. So we saw that Jackie shared that, for some reason, FHA has dramatically increased. But when we do a head-to-head comparison of conventional versus FHA, in most cases, conventional is a better product for the customer because of that ongoing mortgage insurance and because the down payment is greater. So again, we just want to encourage you to take a look at conventional versus FHA and really decide what's the best product for your customer. We don't sell against FHA. In some cases, that may be the right product for your borrower, especially if they have higher debt ratios and lower credit scores. But all things being equal, conventional is usually the better way to go. You got a better odds of getting your offer approved. A lot of sellers and seller agents will shy away from FHA if they have a conventional offer that's equal. So those are just some things to think about. Some more highlights of the HFA Advantage mortgage program. So again, it is for one unit primary residences. It does allow for purchase or no cash out refis. I talked about the LTVs and maximum CLTVs. On the CLTV side, so it does allow to 105% total loan to value. So what that means is you can use additional down payment assistance programs. I know in many areas, there are local programs as well that you can use. In some cases, there are even employer-related programs that you can use. So again, HFA Advantage allows you to go all the way up to 105% total loan to value. Flexible funding options for down payment and closing costs. Again, I mentioned no reserves required, but that's also a compensating factor. We defer to the HFA for income limits. So whereas our Home Possible is limited to 80% of the area median income, for this program, we defer to the HFA, who in this case allows for higher income limits. This is available to first-time home buyers, repeat buyers, borrowers seeking no cash out refinances. We do require a loan product advisor, so we do require you to run LPA. And again, if you're new to this, if you haven't used LPA in the past, we have a lot of resources available to help you. I have Kenya and Jim Clement on the line today. Myself, again, I'm totally accessible. You can contact me by phone, you can text me, you can email me. We're here to help walk you through Loan Product Advisor if that's something that you haven't used in the past or that you're not comfortable with. And again, we have our great 1-800-FREDDIE underwriter line where you can call and speak to our underwriters, and they will help you not only submit it into LPA, but also help you interpret the LPA feedback certificate so you have a good understanding of what that feedback certificate is trying to tell you. And then finally, flexible MI options are also available. Moving on, I already spoke about this, but this is just a great illustration of the charter level mortgage insurance required. And you can see that it's roughly half of the coverage required for standard mortgage insurance. And again, what that equates to for you is a lower payment for your borrower or more leverage, being able to purchase more of a home or make a stronger offer in a very competitive market. Why would you choose HFA Advantage over FHA? Like I said, we don't sell against FHA. In some cases, that may be the right product for your borrower. But when we're doing a head-to-head comparison, HFA Advantage, going conventional is usually the better way to go. Because for one, the mortgage insurance ends when the LTV is less than 80%. On FHA, the mortgage insurance stays for the life of the loan. On the conventional side, we only require a monthly premium. On the FHA side, they require an upfront premium and a monthly premium. And that upfront premium is also usually rolled into the loan. So not only are they coming up with a larger down payment at 3.5%, but they're also financing the upfront mortgage insurance into the loan, so putting them at a lesser equity position than they would be on a conventional loan. MI required only if the LTV is 80%. On the FHA side, it's required regardless of what the LTV is. And again, as I mentioned, no upfront mortgage insurance on the conventional side, and upfront mortgage insurance is added to principal and amortized. So again, that's putting them in a less strong equity position. So it's going to take longer for them to want to refinance, for instance, or sell for that matter. So just things to think about when you're, we would encourage you not to just automatically default to FHA, but to take a good look at the conventional side and really determine what is the best product for your borrower. Moving on, so taking a look at Loan Product Advisor and submitting your loan into LPA. Before we actually talk about that, I do want to talk about the 3 C's of underwriting used in LPA or Loan Product Advisor. You know, a lot of times we have loan officers who call and speak to our underwriters, and they can't understand why their loan was not approved. And they say, you know, hey, I got this great loan. I can't figure out why it's not approved. So, you know, the underwriter will go over the 3 C's, and usually just by doing that will help determine, you know, why the borrower was not approved and what they can do to get that approval they're looking for. And so the 3 C's are credit reputation, capacity, and collateral, also referred to as the 3 C's. So if one of these components is not accessible, or if there is excessive layering of risk across components, the mortgage may not be acceptable for sale to Freddie Mac. This is what the 3 C's look like under credit reputation. Credit score, that's kind of obvious. Foreclosures, bankruptcies, liens, or judgments, there's certainly some time restrictions that are required. Mortgage delinquencies, certainly that's a big one. Credit delinquencies, repos, collections, charge-offs, credit accounts. So this is a big one that folks often miss, and that is credit accounts. Not only the type, so they want to see different types of credit accounts, but the big one here is also age. So quite often our loan officers will call our underwriters and say, well, you know, I have my trade lines. I can't figure out, you know, why I'm not getting approved. But those trade lines may be brand new. Some of them, you know, are less than 12 months old. So we're really looking for those trade lines to be aged at least 12 months and, you know, preferably 24 months. Also, they look at the limits on those trade lines. So if they're pushing their credit card maximums, that's certainly, you know, another factor. And then usage and status of revolving account. So those are big ones here. Also, credit inquiries in the last 12 months. That's another thing that LPA will automatically look at. On the collateral side, the borrower's total equity or down payment. So again, we do only require 3% on the conventional side, but sometimes, you know, if the borrower has those funds available, making a 5% down payment versus a 3% down payment could make the difference in getting that loan approved or not. Certainly property type is another issue. And then property use, whether it's a primary residence, second home, or investment property. On the NIFA program, you know, it is going to be for primary residence, but these 3 C's also apply to your general underwriting as well. Certainly debt ratios, qualifying monthly housing expense to income ratio, monthly debt to income ratios are factors. Salaried versus self-employed borrowers, cash reserves, number of borrowers. So 2 borrowers is certainly stronger than having 1 borrower. You know, the common thought is if one of those 2 borrowers should, you know, find themselves in a financial hardship, the other borrower may be able to shoulder the weight, at least for a brief period of time until that other borrower can recover. But if there is only 1 borrower and they find themselves in a financial hardship, they're going to default a lot faster. And then certainly loan characteristics, whether it's a 15, 20, or 30-year fixed loan, whether it's an adjustable rate loan, and then the purpose of the loan, whether it's a purchase or refinance, and then if it's a refinance, whether it's a cash out or no cash out refi. So, you know, when you run your LPA feedback, And if you don't get the approval you're looking for, these are some of the things that you want to look for. Of course, like I mentioned before, we are highly accessible. You can call me, you can call our underwriter line, and we'll go over this with you and help determine what can be done, if anything, about getting that approval that you're looking for. So we want to make sure you select the correct product, and I can't tell you enough how often folks select the wrong product. It happens all the time for different reasons. Some cases it happens downstream, so the loan officer may have originally selected the correct product, but somewhere along the line, maybe the loan processor or even the loan officer changed it by accident. So you want to make sure that you have the Home Possible Advantage for HFAs or HFA Advantage. So depending on your LOS, it's going to read as one of the two. Again, that's HFA Advantage or Home Possible Advantage for HFA. Those two programs are one and the same. And in some cases, there's a code. So the code number is always going to be 251. And that's another way just to ensure that you've selected the right product. Again, I can't stress enough how often we will have loan officers call our underwriters saying, I don't know why this isn't getting approved. This is a great borrower. And the first thing they check is the loan product and find out that the loan product is wrong. So can't stress that enough. Moving on, and I'm going to do a quick time check here. Okay. So down payment assistance, amortizing subordinate loans. With NIFA, they do have a amortizing subordinate loan. So you just want to make sure that you're entering the monthly payment in the other financing and P&I field in the monthly housing expense breakdown section of your LOS or LPA. So this is a screenshot of LPA. It may look different in your LOS, but again, what they want to see here is that monthly payment, other financing, P&I. So this would be the payment of that second mortgage. Of course, you also want to make sure that you've input these other fields as well. One that folks miss a lot for some reason is mortgage insurance. So for some reason, people forget to put that in there. But again, you want to make sure, especially if you're using the second mortgage, that you enter the other financing P&I, that mortgage payment, so that it's calculated correctly, so that the debt ratios are calculated correctly, and then also so that the LTV and CLTVs are calculated correctly. Subordinate financing. So in addition to entering the monthly payment in the other financing and P&I field, in the monthly housing and expense breakdown section, you want to enter the total amount of the amortizing subordinate loan in the subordinate financing field in the details of transactions section of your LOS and LPA. So again, it may look different, but whether you're in your LOS or directly in the LPA, you're going to have a details of transactions section. And in that section, you will find subordinate financing, and you just want to make sure you have that subordinate financing amount entered correctly. And again, you know, when we're referring to this, we're referring to a second mortgage, such as NIFA's, that has a payment. There are other second mortgages that may not have a payment, at least for the first 61 months. And in that case, you can enter those loans as a gift. And so you'll see here on this screen, enter the following types of down payments in the total gift field located in the assets and reserves section of your LOS or LPA. So an affordable second that does not require payment within the first 60 months, or if you have a grant that is not required to be repaid, you can put that in the total gift fund field in the assets and reserves section. So once again, this is what LPA looks like. Your LOS may look different, but no matter what, in your LOS, you will have an assets and reserves section, and that's where you would enter the gift, either a second that doesn't have a payment within the first 60 months, or a grant that is not required to be repaid. So as I mentioned before, HFA Advantage does not require reserves unless LPA determines reserves are necessary to offset other underwriting factors. Because reserves are a compensating factor in LPA decisions, it is always advisable to verify a borrower's reserves and include them in the assets and reserves section of your LOS or LPA. In fact, we've seen where loan officers didn't enter reserves simply because they didn't think they had to. So the borrower had reserves, but for some reason, because they thought reserves were not a requirement, they simply did not input those reserves into the assets and reserves section. So again, I can't stress enough, even though reserves are not required, it's usually a good idea, especially if they have the reserves, to input those, because that is certainly a compensating factor. So this is what the feedback certificate would look like. And again, here, I just want to stress again, when you get your feedback certificate, you want to make sure that the offering identifier has not changed. So in the feedback certificate, it's going to talk about the product type, interest rate, loan amount, but you're also going to see offering identifier. And that's where you want to make sure it says HFA Advantage or Home Possible Advantage for HFAs. That's going to help confirm for you that you have in fact input the correct loan product. And then in the general messages section of the LPA feedback certificate, you're going to want to review the following messages. And I'll pause here to say and to remind you that you are going to get a copy of this presentation. If you've registered, if we have your email address, then we will be sending you a copy of this presentation. Again, you can always feel free to reach out to me or underwriters directly as well. So message 81, verify the borrower's qualifying income meets the HFA's program's income limits. So here it's going to tell you that what it's going to confirm for you is what the qualifying income entered is. And then you're going to want to make sure that this number matches HFA's NIFA's income limits. It's also going to tell you what the area median income is. And then it's going to compare the borrower's qualifying income to the AMI and indicate whether it's 80% or 50%. So it's going to calculate that for you. It's going to say based on the qualifying income, so it knows what the qualifying income is, and it knows what the area median income is. So it's going to tell you that this particular loan is below 50% of the AMI, and so it meets the low income purchase housing goal requirements of less than 50% or 80%. So basically what this D2 is doing is it's breaking down the area median income by 80% and 50% for you. But you certainly want to make sure that you're not only checking this, but you're also comparing that to what NIFA's income limits are. You're also going to want to verify homebuyer education requirements. In this case, it'll tell you whether homebuyer education is required. Again, you're also going to want to refer to the HFA's requirements. So here it even says homebuyer education is required only as specified by the HFA. But once again, you're going to want to check that KU message. And then here in the assets and reserves section, the LPA feedback certificate, you want to review the following messages. If applicable, message B8 identifies the amount of DPI entered in the total gift fund. So if you entered DPA as a gift, you're going to see it here, section B8, loan was submitted with $5,000 in gift funds. If applicable, message NW prompts you to obtain from the HFA documentation evidencing the DPA entered in the total gift fund field. And then finally, especially for this program, message GS prompts you to verify borrower's funds and subordinate financing. So this is where you're going to see what the borrower's funds are required, and it's also going to calculate that subordinate financing for you. Here you see proceeds from subordinate financing, in this case, $5,000. So all of these messages are there really just to help you and help confirm that you've entered all the information correctly. And again, if you're having problems deciphering all that, you can give us a call. We're highly accessible. In the assets and reserves section, you want to review the following messages. So message G0 indicates the amount of reserves entered as reserves. And then message CN prompts you to obtain account statements documenting the reserves for the loan file. So it wants to make sure that you've actually had the documents to confirm those reserves. Mortgage insurance and fees. So like we mentioned before, if the borrower is at 80% of the area median income or lower, they qualify for that charter level mortgage insurance. In the mortgage insurance and fees section of the feedback certificate, it's going to break that mortgage insurance for you. So it'll tell you this HFA Advantage mortgage requires 18% of the coverage if the area median income is less than or equal to 80% of the area median income. and 35% if they're higher than 80%. So you'd want to go back on the feedback certificate. It already broke down what 80% and 50% is for you. And so you'll be able to confirm the correct amount of mortgage insurance. As Jackie mentioned before, you know, that's really hard to correct post-closing. So it's something that you want to make sure that you're entering correctly from the beginning. And once again, if you have any questions, you can always run that scenario past us to make sure you're doing it correctly. Eligible accept. So this is what you're looking for on the feedback certificate. If you get that eligible accept, it means that your loan has been approved and you can celebrate. That's really what we're looking for here, eligible accept. And so now I'll transition just to our Credit Smart Homebuyer U and additional tools and resources. So Credit Smart Homebuyer U, this is our homebuyer education requirement. And so we saw that NIFA already said that they allow this. One of the differentiating factors of this program is that it's absolutely free. We know that there's a charge for, certainly for Fannie Mae's program. With Credit Smart Homebuyer U, it's absolutely free. It's available as a self-paced online program that fulfills first-time homebuyer education requirements for Home Possible, Home One, as well as HFA Advantage. So again, here's a link to Homebuyer University. And one thing I cannot stress enough is you definitely have to have this completed before the note date, or that loan is going to be unsellable. And it's very unfortunate. And, you know, we'd be surprised how many loan officers miss this, even though we tell them over and over again, make sure you get this certificate done prior to the note date. And as Jackie said, the sooner, certainly the better. So you are the critical link to helping well-qualified borrowers achieve their home ownership objectives. You want to provide access to credit and originate loans to the full extent of Freddie Mac's credit box. So weigh your options against FHA. If FHA is your automatic, consider conventional, take a look at them head to head and see what's going to put your borrower in a better position, not only now, but also in the long term in the future. Utilize your mortgage finance expertise. And then this is the big one for me. You want to explain the process and dispel the 20% down payment myth. You know, how many of your borrowers still think they need 20% down to purchase a home? It's really up to you to explain to them that A, they don't need 20%, that it's going to take a very long time for them to be able to save for that 20%. And there are programs like NIFAs that allow you, that provide down payment assistance to help bridge that gap to home ownership so that you can become a homeowner a lot sooner. This is a breakdown of the coverage. So you can see here my name, David Mendez, Lender Engagement Manager. That's my email address. That is my personal cell phone number. Again, don't hesitate to reach out to me. Text me, call me, email me. I am accessible. This is the coverage. I have two other counterparts who handle the Midwest and the East as well. And then finally, this is that super secret hotline that I was talking to you about. Most of you are already familiar with our 1-800-FREDDIE phone line. If you're not, to reach us, it's 1-800-FREDDIE. But the real trick is knowing which extensions to press. So first of all, you are going to want to have your seller servicer number accessible because they will ask for that. But you're going to want to enter extension 1, and extension 1 again. So we have a team of underwriters that have been specifically trained in HFA Advantage programs that really understand HFA lending and all the subtle nuances that HFA programs have. These underwriters are experts in HFA lending, and they can really help understand your program, your specific scenario, and help walk you through it to get that approval that you're looking for. Like it says here, it will review individual loan scenarios. So if you can't figure out why you're not getting the approval, give us a call. We'll help you out. And then again, it says assist with LPA feedback. Sometimes, especially if LPA is new to you, it may look different. It may sound different than the DU that you're used to. So sometimes it takes a while to understand exactly what that feedback certificate is trying to tell you. You're reading it and you're saying, well, what do I need to do here? So again, call our 1-800-FREDDIE line, extension 111, and that's going to get you to our team of underwriters. And they're happy to hear from you. And with that, I'll thank you, and I will turn it back over to Nebraska to probably going to go to US Bank next.
Thanks so much, David. Great presentation. I want to mention again that this webinar is being recorded, and we will post it out on our website as soon as possible. And we will send out an email, like David said, with a link to the webinar. So Sally Mazzola with US Bank is up next. So David is going to pass the baton to her. So take it away, Sally. You are on mute, Sally. I can't hear you.
Now you can, I hope.
I can hear you now.
Good morning, everybody. Good to see you. Good to be with you this morning. Great to be partnering with NIFA and Freddie Mac to offer the HFA Advantage program in your area. And I'm going to go through very briefly our website. We've changed it. I want to go through that with you, give you some contact information for US Bank. So without hesitation, I'm going to jump into that so we have enough time for questions. And for some reason, can you see my screen, Jackie and Stacy?
Yes, I can see your first slide.
Okay, excellent. Okay. All right. Let's try to go to the next screen, and hopefully that's going to cooperate for us. Are you seeing the next slide?
No, I am not.
Okay, because for some reason, I'm not able to advance to the next slide for some. How about now?
Yep, I can see it now.
Oh, okay. Excellent. Okay, here we go. So just to let you know, our website, if you haven't already seen or heard that we changed our website is now usbank.com/correspondent. And that's where you're going to find our seller guide updates, who to contact at US Bank. And I would encourage you, if you haven't been in there in a while, that you get in there and take a look at what we have available to you. We've got a lot of resources available, and please use them. So if you're going into the website, in case any of you get stuck when you go in there, it's very important that you scroll down through a little bit and you click on Learn More, where it says Enjoy Housing Finance Agency Services. So don't necessarily click the first thing that you see on that web page. Scroll down and find the information under the Enjoy Housing Finance Agency page. Once you get there, you're going to see our HFA lending guide. And what I did want to point out, similar to what David was talking about, is we have a whole area section dedicated to COVID. All the bulletins that we've published over the last few months. If you're wondering about any of that information, changes, temporary changes, I would definitely reference that area for those questions. Now, getting into some really important areas of the website, Section 900 is the delivery and funding section. You're going to get a lot of information on closed loan delivery, our requirements, how to endorse notes, things of that nature. And I'm sure most of you probably have been in there at least once or twice throughout the period that you guys have been participating with the NIFA program and with US Bank. To the right of the screen actually gets specific. And Section 500 is where you're going to find the information on the NIFA program. You're going you could actually link up to their website if you needed to from here. You will also be able to access the HFA specific required document checklist, and also what our program fee schedule looks like for the program, in addition to the product guides for both conventional and government. What you'll notice when you go into the conventional product guides is there's now information that references the Freddie Mac program. It references certain aspects of the Freddie Mac product and what we would require with respect to Freddie Mac HFA Advantage. So I would encourage you to take a look. It's posted in there for your convenience. So please don't hesitate to look. The other sections, very quickly, Section 1000 has all our bulletins and communications that are sent out and have been sent out. Under 1100, exhibits, forms, and checklists, that's where you're going to find the general loan delivery checklists. Also, very important is not only do our product guides talk about credit overlays, but also we have a general overlay matrix in section 1400, which would be applicable to any programs that you'd be participating in with U.S. Bank. The most important thing is contact information, and I will tell you, we've got a great support help desk. Two areas. The first area is the lender support help desk, and the 800 number is posted there. And this would be for new lenders, existing lenders, questions about the product guidelines, general information, or just direction, how to get information on going through U.S. Bank's website better than I'm doing right now. And also the shared mailbox. If you want to send a question, get it back in writing. If you call, you want to select option 2, and you'll get that general information support. If you want information on specific things, your loan status, you submitted deficiencies and you haven't heard back, or you're not understanding what documentation we're asking for you to provide to us so we can clear the loan for purchase, contact our customer care team. They're a great group. And if you call that same 800 number, you'll select option 1 to get them directly. If you want to send them a question so that you can get it in writing, send it to the HFA customer care at usbank.com address, and they'd be more than happy to assist you. As I said, I'm going to be brief today so that we can get it back to Jackie and David and to answer any questions that you might have. Jackie?
Hi, everyone. I'm assuming Jackie will come back here in just a second. One question that we did have pop up during the webinar was regarding the Homebuyer U Homebuyer Education Program. And Amy asked if there is any chance that Homebuyer U will be offered in Spanish anytime soon. Oh, David, you're muted.
I don't have a date, but that's certainly in the works. In fact, our Credit Smart, which is our financial literacy program, is available in 5 languages currently. Homebuyer U will certainly be in Spanish and other languages as well, but I don't have a date of when that's going to happen.
Okay, thank you. Looking to see what else we had here.
I had a few questions as well that came up, if you'd like me to share those.
Absolutely.
So one of them was, what are some of the main differences between HFA Preferred, which is Fannie Mae's, and HFA Advantage? So as far as, there are a few things. So first of all, we do not allow manufactured homes, and HFA Preferred does. And we also do not allow non-occupying co-borrowers or co-signers. HFA Preferred does. As far as the underwriting, though, we are a lot more favorable on student loans than HFA Preferred is. HFA Preferred, well, we will defer to the credit report, and whatever payment is showing on the credit report, we will accept. If there is no payment, or if the payment is deferred, then we will take half of the unpaid, or 0.5% of the unpaid principal balance, versus HFA Preferred, which takes the full % of the unpaid principal balance. So that's a huge deal. So especially if you do have borrowers who have student loans, certainly consider Freddie Mac. And then we are also more favorable for self-employed borrowers. So if a self-employed borrower has been in business for 5 years or longer, we will only require 1 year's tax returns versus HFA Preferred, which requires at least 2. Now that may be different. NIFA, you guys may require 2 anyways, I'm not sure, but HFA Advantage does not require, only requires 1 year if you've been in business for 5 years or longer. Another question is, where on the feedback certificate I find a mortgage insurance requirement. I did share that, and that's in the mortgage insurance fees section. Can you manually underwrite? Absolutely, manual underwriting is allowed. We do have posted maximum debt ratios. I don't know what they are off the top of my head, but there are some guidelines that you need to stay within. And then the last one is, how do I get signed up to use LPA? We have a link that I'm going to share that we can forward to to everyone who has registered, but it's pretty easy. Follow the link and it'll give you all the setup instructions on how you can get set up with LPA if you're not already set up for that. And those are the questions that I had.
Perfect, thank you. David, I had one question for you, and maybe this is not something that you can answer, but you mentioned the large millennial market and the minority market.
Mm-hmm.
Does Freddie Mac have any pieces of information about how to market to those particular groups?
Absolutely. So we do have an insights page. It's fantastic. It's available for both loan officers and real estate agents. And in that insights page, it gives you a ton of information about all different demographics, millennials, minorities, women, and it gives you tips and tricks on how to market to them, how to communicate with them, what their challenges are. So for instance, on the minority side, challenges usually access to credit, credit scores and down payment. So it talks about, what those challenges are and then also how to overcome. So I'll make sure that I share a link to that as well. Another thing I would say about that insights page, especially for loan officers and real estate agents, Facebook and Instagram are a great way for you to market out there, and we do see that. But what loan officers and real estate agents struggle with is content. What am I going to say? If you go to our insights page, we have hundreds of hours of content for you that you can, share with your audience and small tidbits and help you just stay in front of your customers and really establish yourself as a local market expert. So I'll be sure to share that insights page. Thank you for asking.
Thank you. I didn't see any other questions aside. Someone had asked early on about the availability of the presentation today. And as Jackie mentioned, and David, you mentioned, Sally, I know you'll be providing that information. We will get that out on our website as soon as possible. Jackie, did you have anything you wanted to add today?
I just had one question or clarification, David. So you mentioned a code, I believe it was 251.
Correct.
Is that correct? That is in connection with HFA Advantage. So if someone is entering an affordable second as well, whether it's amortizing or a gift or a grant, is there a special code for an amortizing second or not?
No, there is not. Yeah, it would still fall under the 251 of the primary mortgage, and then you would just enter the details of that amortizing second. So there's not a separate code for that.
Okay. All right. Stacy, do you have anything else? There's no other questions in the queue?
I didn't.
Now's your time to ask David anything you wanted to know about HFA Advantage, and I'm sure questions will come up as lenders start using the product.
Absolutely. I think we have touched on most everything that was in the questions box, and I do appreciate people who asked those questions today.
Yeah, I will mention one other thing. When I was talking about differences between HFA Preferred and HFA Advantage, one huge difference, we're highly accessible. I've said that before, I'll say it again. You can call me, text me, email me, and we have a great, fantastic team of underwriters that will go through your scenarios. You can reach us, you can call us on our 1-800-FREDDIE line, and they will handhold you through this process if that's what it takes. So, again, we want to hear from you. Don't hesitate to reach out to us. We're here for you.
That's perfect.
Yeah, that's wonderful, because I know Stacy and we do get calls from lenders trying to help resolve findings. So that's wonderful that you have a dedicated team for lenders to reach out to.
Absolutely.
All right, Sally, do you have anything else you wanted to add?
Nope, just happy to be involved. And if you need any information from us, provided that information to you on the presentation. Like Stacy said, I'll get that presentation so that it can be posted and you guys can reference that information. But looking forward to working with the lenders through HFA Advantage.
Right, so we plan to start allowing HFA Advantage loan reservations within the next week or two. So we'll reach out to lenders who are not approved to use Loan Product Advisor, like David mentioned. Thanks very much for your participation in this webinar. A big thanks to David and his team and Sally for your help and support of NIFA's homeownership program. We can do great things when we all come together to make homeownership affordable and sustainable for first-time home buyers. Hope everyone has a great rest of the day. Thank you.
Bye. Thank you, everyone.
Thank you.
Take care, everyone. Have a great day. Stay safe.